You'll hear Nasdaq call this an upgrade. In reality, it's a signal, another domino in the largest wealth transfer of our lifetime. Stay to the end and you'll know the single smartest place to stand before the switch, so you aren't watching history from the bleachers. You're watching the reset happen in real time. The proof isn't a tweet or a rumor. It's the most conservative players quietly changing the rules of ownership so value moves like information. When that becomes normal, the gap between insiders and everyone else explodes. The part almost no one connects is simple. When a conservative market pillar moves stocks on chain, it proves the rails are being replaced, not repaired. That shift isn't isolated. It syncs with politics, law, and global banking infrastructure. The story isn't about code. It's about custody, control, and who captures the spread when everything clears in real time. Here's the paradox that should make you sit up. Markets trade in microseconds, but ownership still crawls for days. That delay is the crack where errors, fails, and quiet gains live. Cutting to faster settlement was never the end state. The end state is finality that settles inside the same environment that carries instructions, cash, and collateral. That's what on-chain rails make possible. Why now? Because the dominoes are finally lining up. One, the political signal is explicit. The next administration says the United States will be the crypto capital of the world and that ancient banking rails will be replaced with state-of-the-art American crypto technology. 2. The legislative domino is in motion. A Clarity Act removes the gray zone that kept institutions stalling and gives cover for exchanges, brokers, and banks to go live. 3. The institutional domino just clicked. Nasdaq is preparing to move equities onto a ledger as a settlement rail. 4. The international plumbing follows. SWIFT begins live trials that route real bank traffic to ledger-connected rails using networks like XRP and HBAR. When policy, law, markets, and global messaging align, the flip isn't optional. It's systemic. Most people stop at the headline. Here's where this gets dangerous. Faster finality is a gift when you're right and a blade when you're wrong. Mistakes finalize before a manager can shout stop. The window for settlement gains narrows. Price discovery gets cleaner. Volatility can spike during the handover because the old delays that hid risk are gone. Treat this as a map, not a myth. Imagine 3 phases that show up in the real world. Phase 1, narrative convergence. Leadership says the rails will change. Congress drafts certainty, and utilities run controlled pilots that move more than test data. Phase 2, rule clarity plus live traffic. The bill passes, custodians and exchanges publish procedures, and real instruments clear inside the new environment at small scale. Phase 3, normalized adoption. A set of blue-chip tickers and 1 or 2 major funds clear on the new rail by default. Month-end reconciliation complaints drop, and the front end quietly exposes instant availability and accurate inventory. Each phase reduces excuses. Each phase moves capital. A quick example to ground this. Think about dividend season. Today, corporate actions bounce between spreadsheets, emails, and files. On-chain, the record is a function. Eligibility is provable in the moment. The mismatch that used to create angry calls simply doesn't exist because the record and the payment live in the same place. Here's the twist at the midpoint. People think this story ends at equities. It does not. Once rails exist that can carry ownership as a live object, bonds move, treasuries move, corporate actions move, repo and collateral move, real-world assets that used to sit in spreadsheets move. Tokenize everything stops being a slogan and becomes a path of least resistance. The same way emails replace memos without a parade, ledgers replace file drops without a billboard. Now the part almost no one connects. Messaging isn't settlement. SWIFT is a messaging network. When it tests ledger-connected flows, it's admitting the future isn't just better messages. It's synchronized settlement. It's delivery versus payment without the delay where errors live. When those trials go live and bank desks see that cash, collateral, and claims can update together, the case for the old rail dies in the room. Here's where this goes from big to personal. If the rails flip, who captures the gains? Not the loudest coin. The settlement layer. The rail that regulators can tolerate and institutions can plug into without breaking their own rules. Most public chains weren't built for that job. Many are fast until stress, or cheap until it matters, or flexible until compliance enters the chat. Private ledgers fix one set of problems and create another because if the book is locked away, markets fragment again. Hold that thought and look at the shortlist with clear eyes. Ethereum is powerful, but fees and congestion are attacks at the exact moment you need certainty. Solana is fast, yet downtime headlines are the wrong story to tell a risk committee. You need rails that are fast, final, cheap, and built to sit in the same room as real compliance. You need rails that already speak payments, custody, and messaging in the language banks use. This is where the reveal lives, and why you stayed. If a public rail is going to carry real settlement for markets, the XRP ledger is the one that fits the shape. It was built for high-speed settlement. Read that again. Settlement, not speculation. The winners will be the rails that move trillions without drama, with receipts any auditor can love. That's what institutions select when careers are on the line. It's engineered for low-cost finality and simple compliance rules. It's the only public rail that keeps showing up wherever payments and markets quietly intersect. Add the fact that international trials are now testing flows that include XRP, and the picture is no longer theoretical. It's probabilistic. It's a bet on plumbing, not hype. Most people will hear the word ledger and think price target. That isn't what wins here. What wins is standing where the rail wins. If the exchange that sets the tone normalizes tokenized settlement, and the messaging network that connects 10,000 institutions proves it can sync with a live ledger, the asset tied to the rail is the place to stand. Not because of a logo, because of gravity, because of how systems adopt a path that removes friction and legal risk at the same time. Here's a simple positioning logic you can use as the dominoes fall. If the Clarity Act clears the key vote, the policy shield is up. If SWIFT publishes a clean month of trial results that show real traffic and stable operations with ledger-connected routes, the bank case is made. If Nasdaq or a peer expands tokenized clearing from a sandbox to a basket that includes a widely held name and a major fund, the equity case is made. 3 green lights don't mean a straight lineup. They mean the flip is functionally inevitable. That's when early movers stop being early and start being obvious. You deserve one more picture before we close. Imagine the day front end stopped hiding the rail. Your broker shows instant availability that mirrors a live ledger. Your stock loan locate is clean because the inventory is provable on demand. The spread you used to pay to the back office becomes a basis point you keep. The panic you used to feel during a rumor shrinks because ownership can be proven in seconds, not reconciled in days. This isn't science fiction. The dominoes are visible. Leadership says the switch is coming. Law clears the path. Exchanges push the button. Global messaging connects the pipes. When the rails flip, the winners are the ones standing in the settlement layer before the crowd reads the memo. That's the opportunity you came for. That's why you stayed to the end. You want these dominoes decoded before they hit headlines? Subscribe now so you don't miss the next move.